Fun fact, if you didn't know, Visa actually directly influences the rewards that you get from your credit cards. So in today's episode, I'll be delving into one of my larger positions, which is Visa. So this is a newsletter that we released on our Substack. It's called Helios Capital Partner. Feel free to check it out. It's the link in the description below. So Visa has been hit very hard recently. The stock is down around 10% year to date. So I thought it would be a good time to do a write-up on Visa, and this is what I've gathered. So I'll skip past the history of the company and go straight into the business model as a whole. So Visa has several different streams of revenue. They have their data processing revenue, they have services revenue, as well as their value-added services. So data processing revenue is mainly their authorization fees. So whenever you use a Visa card and you pay for something, Visa is going to charge the merchant a fee, and this fee is around 20 cents per transaction. And then there's the other revenue stream that Visa gets as well. This is your assessment fees. It is under your services revenue. So assessment fees is typically a percentage of the payment that is being transacted. So in this case for Visa, it's typically between 0.13 and 0.14% of each transaction. And this makes up around 30% of the gross revenue. Visa charges for the assessment as well as the changing of the currency as well. Last one, the most value accretive one currently is their value-added services. So value-added services, I'll be delving into it later on. They have many different arms under value-added services, and it is the key moat defender for Visa in today's age. Okay, so moving on, this is a visual illustration of their revenue streams. There's this thing over here, which is client incentive. Client incentive is the money that they pay out to the banks to incentivize them to issue out Visa cards. So to understand Visa's mode, we must first understand the entire payment sequence, and below are the specific players that are involved in your payment transaction. So number one, you have your merchant. Merchants are the shops that sell you the goods. You have the consumer's bank, which is also called the issuer's bank. And then you have the merchant's bank, which is called your acquiring bank. And then you have your payment network, which is Visa and MasterCard as well. And then you have your payment processor, which is the one that handles the POS system, the one where you swipe your cards. So the sequence goes like this. Normally, it will start off with number one, which is authorization. So whenever you swipe your cards, what happens is this. The data gets sent from the POS to the merchant bank. And then the merchant bank will transfer it to Visa, who will then transfer it to your issuing bank to try and see if there is a match. And then after that, they'll put the funds on hold on the issuing bank side. And then they'll route it back, and then Visa will route it back to your merchant. So that's part one. And then part two is called clearing. So clearing is sort of like handling the receipt at the end of the day. So what Visa and MasterCard will do is they will pass on all the receipts. So your chargebacks, everything, your obligations, they will pass it all out to your merchant and your issuing banks via their infrastructure, which is called VisaNet. This is also where they charge their assessment fees. And then last of all is your settlement. So settlement is when your consumer bank transfers the money to the network, and then the network will transfer it to your merchant bank. So the entire sequence is something like this. And as you can see over here, Visa is in the middle. It sort of operates as the middleman, controlling everything, controlling the flow of the funds, controlling the flow of the data as well. So the incentives are typically as follows. So your consumer banks, they normally take the entire interchange fees. So interchange fee is a fee that is attached to a specific credit card that is charged to the merchant's bank, who will then pass it on to the merchant. So in this case, your consumer bank, they typically take the interchange fee. They take the majority of it. Visa and MasterCard take between 0.13 and 0.14, as we mentioned earlier. And then your merchant bank take the 0.05 and 0.2% of the total transaction volume. And then everything else is passed to the merchant. So in this entire sequence over here, the one that loses is your merchant, of course. So interchange fees are charged to the merchant's bank, who will then pass it on to the merchants, and received by issuing banks with fee rates set by the payment network, which is Visa as well as MasterCard. So you can think of it this way. Visa and MasterCard, they will set the interchange fee for a specific credit card. And the higher the interchange fee, the higher the amount of money that your issuing banks receive, because higher interchange means they get to collect more of the entire payment volume. So in a way, Visa and MasterCard's revenue is not tied to the interchange fees, yet they are the ones setting the interchange fees. So higher interchange fees also allows for greater consumer rewards, because your rewards, they come from the issuing bank receiving these interchange fees. So when you talk about rewards, it is actually set by Visa and MasterCard in a way. So higher interchange fee allow issuing banks to fund greater consumer rewards, reinforcing card usage and issuer preference, while Visa and MasterCard act as the middleman to continue expanding their merchant acceptance. Because high-ticket items account for a disproportionate share of payment value, the loss of rewards materially affects the consumer's behavior, despite representing a small share of transactions. So what that means is that high-ticket items are typically the ones that will require your credit cards because it will give consumers greater amount of rewards. So the point here is not that the interchange fee incentivizes the issuers and the consumers, but more importantly, it is to point out that Visa is the rule maker. Same thing for MasterCard as well. So they are the rule maker, they set the rules, they set the amount of money that your issuing banks receive, and they incentivize the issuing banks. So the issuing banks, they don't want to switch because Visa and MasterCard are already offering something that is significant. On your consumer end, they are providing the funds for greater rewards as well to increase adoption by consumers. And on the merchant bank, this is what I'll touch on later, Visa and MasterCard are also offering something to your merchant bank to try and lower the resistance from that side. Okay, so let's move on to the merchant side. So just now I was referencing the consumers as well as the issuers and talking about how they can't switch. Now on the merchant side, they are the ones that suffer the most. So your merchants normally have two different options that they can make. Number one, they can reject the sale, which means they lose all the revenue because your consumers will find it a bit more troublesome if they will have to switch to another payment choice. And then second of all, they can pressure consumers to use a card from a different network that has a lower interchange fee. Like for example, Discover, Star, NYC, maybe even American Express, although American Express one is higher. Or third of all is that they ask for payment in cash, which is highly unlikely. So number two seems the most viable, which is to pressure consumers to go and switch to another payment network. And this leads me to the second most important portion of Visa's entire business. It is called value-added services. So value-added services has become something that is quite important for the entire business. It's driven around 24% of total net revenues last year per the CEO. So the current value-added services reported under their value-added services line is their consolidated revenue streams relating to consulting as well as analytics only. So they have many different other value-added services that they offer as well. They're embedded under the data processing as well as the services revenue. So the revenue mix for the primary products are as such. You have 40%, which is issuing solutions. You have around 28%, which is tied to acceptance solutions. And then you have 17% tied to risk and security solutions. And then 15% is tied more to consulting. So value-added services has seen significant growth over the years. And it is currently now the primary driver for the growth. So I'll talk about the different revenue segments under value-added services. First of all is issuing solutions. So issuing solutions is the data that Visa provides to your banks to try and make sure that they fine-tune their rewards to increase retention on the consumer end. And besides that, they also provide a cloud-native software for the banks to manage the cards and the accounts. And they also allow for transaction control. So in your bank app, for example, if let's say you need to freeze your card, this is where Visa comes in. So Visa makes use of the data that they collect from transactions, and then they offer them to banks under this segment, allowing banks to gain insights into card-linked offers and provide APIs for notifications related to rewards redemption for consumers. Second of all is tokenization. Tokenization is the idea of using tokens for specific purchases at specific merchants. So you can think about it this way. So two tokens cannot be swapped and they cannot be used at different merchants. So this significantly lowers fraud rates because you can't use the same token at another merchant at a different time as well. Tokenization is not a payment method. It is a management system similar to managing of passwords that can be used for payments. What Visa and MasterCard are currently doing today is they're offering this tokenization service, and tokenization is increasing authorization volumes, reducing fraud as well. So what tokenization does is tokenization will replace the 16-digit numbers that you have on your credit cards. And then when a credit card is added to a wallet or a merchant, what happens is Visa's token service will generate a token that is linked to this 16-digit number, and then they'll store it. And then after that, whenever a transaction is being passed through, what will happen is that Visa will offer this token. Visa will detokenize it. So they'll convert the token back into a 16-digit number, and then they'll route the transaction back for authorization. So tokenization reduces fraud and improves authorization rate. And you can frame it this way as well. As technology improves, the amount of fraud that will come about will increase over time. So what Visa is positioning themselves today is they're trying to become an anti-fraud company. They're trying to basically ride on the tailwind of this entire technological improvement, leading to more frauds, therefore leading to more fraud protection being needed. So the other thing that Visa is currently offering is Visa's Advanced Authorization. This is an internal scoring system, another one of the company's offerings. And currently, as management has highlighted, the amount of tokenized transaction has been increasing exponentially over the years. And the company is targeting for around 90% of all transactions to be via tokenization. So tokenization is actually a good thing for your online payments as well. So for example, if let's say you're subscribing to Netflix and let's say your card expires, so your 16-digit card expires, what happens is Netflix can no longer charge for that card because the card has already expired. So what tokenization does is that even though that card has expired, Netflix will still be able to continually charge, and this reduces the risk of churn on Netflix end as well. So it is also beneficial for companies that operate primarily on internet as well. So as I mentioned earlier, with increasing risk of fraud and increasing technological advancements, the need to reduce fraud is a secular tailwind that Visa is riding on. 75% of merchants acknowledge that fraud protection is their highest priority. Visa's unique power dynamic allows it to upsell products outside of its core offering. Expansion of tokenization outside of cards will come in the form of bank account numbers to indirectly monetize account-to-account transfers, an alternative to Visa that will be covered in a later part. In terms of fraud rates and comparisons, the Fed released data regarding Visa and MasterCard's fraud levels at around 17.9 basis points, compared to single message transaction from primarily Star as well as NYC at 6.7%. So what they're saying is that Visa and MasterCard are actually more at risk of fraud. So maybe Visa and MasterCard's anti-fraud system is weaker. While this paints a weak picture, it is a bit flawed. So a key thing to note here is that a large proportion of Visa's transactions are online, which typically has a higher level of fraud as compared to in-person payments. So card-not-present transactions for dual message transactions are currently around 61% of the total transaction volume compared to single message transaction, which is Star as well as NYC. So I adjusted the numbers, and for illustration purposes, this is to check whether or not the actual fraud systems that Visa employ are actually good. And based on the numbers here, they are actually lower as compared to Star, if you were to go and make some assumptions. So my assumptions are here. Feel free to check it out. It's in the news. So that's the value-added services part. I think the value-added services portion is currently riding on a wave of technological improvements, and it's a business that is currently under-penetrated as well. So management actually said that the penetration rate is around 1 to 2% out of the entire $520 billion addressable market. So Visa's value-added services currently still quite small, and it's a key growth driver for the company today. Okay, so now I'll move on to different regulatory hurdles for Visa. So the first one is the Durbin Amendment. This was in 2010. So the Durbin Amendment pushed for a cap on debit cards. So they basically placed the ceiling in terms of the interchange fees that can be charged on debit cards. The EU did something similar as well in debit card transactions as well as credit card transactions. So with interchange fees reduced, what happens is that your banks will have the card rewards. So that was why your debit cards became unattractive about 15 years ago. And despite the Durbin Amendment, Visa and MasterCard were still able to grow quite significantly as well. Because what they did over here was they reduced the assessment fees, and this continued to encourage Visa card issuance while also expanding merchant and brand usage fees. They also introduced administrative and brand usage fees for merchants, and despite the regulations, Visa's payment volume in the following year actually increased by 14%, outpacing credit cards at 7%. It's quite ironic. The overall revenue for the company grew at 13%, with US revenue up 8% year on year. Net revenue yield fell because of a lower take rate. But after that, it soon recovered because they introduced additional fees, they provided additional services that mandated the price increases as well. So the next risk for the company today is the CCCA. CCCA is your Credit Card Competition Act. This was what Trump has been pushing for a few months already, and he officially endorsed it on Truth Social a few months back. So the CCCA implementation is similar to the Durbin Amendment and mandates for 2 unaffiliated networks in each credit card. So Visa and MasterCard are not allowed. But the key thing to note here is that the CCCA is currently not operational. One, the regulatory hurdle for it to be actually passed is very high. Trump is pushing it on Truth Social, but on the back end, it is not something that is tangible. Second of all is that there are no alternatives to Visa as well as MasterCard today. So credit cards require something called dual message networks. But alternatives like Star, like NYC, they only have single message networks, which is suitable for your debit card transactions. So significant investment is needed, and it's almost impossible for them to build it in Trump's current term. So the CCCA breaks card exclusivity. Currently, Visa has exclusive agreements with issuers, shifting the choice of networks to issuers as well as consumers. With the inclusion of a second network, this decision could be passed on to your merchants instead. So what I did over here was I assume a scenario whereby Visa loses around 50% of its existing credit card volumes in the US to competitors like Discover or potentially Star and NYCE, although Discover is unlikely because Discover was acquired by Capital One, so this reduces Discover's appeal to external banks and external issuers as well due to lack of control. And what I did over here was I calculated the amount of volumes that they will lose, and it's around 10% of total volumes if they lose 50% of their existing credit card volumes in the US. So this is an aggressive bear scenario, and the stock is down around 15% since the announcement already. This was actually a while back. In my opinion, the markets have already sort of reflected the regulation into valuation, although the regulation hasn't played out yet. Or perhaps the market is pricing in the fact that there is reduced predictability for the business. So I think the CCCA is something that is not possible currently, and I wouldn't take this into account when I'm investing in Visa and MasterCard today. The next one is the EU. I think this one is more tangible. So the EU has been critical of Visa as well as MasterCard for years. So they're afraid that Trump will weaponize it currently. If you've been following the news, the EU is currently afraid that Trump will weaponize the card networks like what he did in Russia. So what the EU has done over the years is they built something called Wero. Wero is an account-to-account transaction method. And currently now they're also developing some other things like your DigiEuro, which is what is causing the stock to fall. So the EU has now shifted their stance from limiting Visa to replacing Visa and MasterCard. Although Visa and MasterCard are currently countering that as well. They're acquiring companies. So for example, Visa acquired a Swedish company in Think, and then they're also embedding themselves into government initiatives. So it's sort of like a frenemy scenario where they're offering their services and then the government is trying to replace Visa and MasterCard. And for Visa and MasterCard, they're also increasingly expanding their value-added services business because they're of the view that these payment networks will eventually be commoditized or is at risk of commoditization. I'll move on. So next one, alternatives to Visa and MasterCard. So you have your account-to-account transactions, you have your closed-loop alternatives, you have MasterCard and Discover, buy now, pay later, and stable coins. I think there's one more here, which is agents. So account-to-account transaction, this is A2A transaction. It is similar to what we have in Singapore, it's pay now. And then in other countries, you have Brazil, which is PIX, you have Wero, which is in the EU, you have UPI, which is in India, and you have FedNow in the US. But the problem with account-to-account transaction is this. It is highly linked to fraud because once the money is sent, it is almost immediately received. Whereas for Visa, your typical merchant settlement speed is around 1 to 3 business days. So this increases the fraud risk for your A2A transactions. And in your Latin America countries, this is actually quite a big problem. And so what Visa has done to counter this is they've created their own A2A network, which is Visa Direct, and they've also included security and fraud systems in their A2A transaction network, which is different from what the existing ones have. And then besides that, Visa's value-added services is also operating on these government rails, with Visa Risk Manager and Visa Advanced Authorization being updated to network agnostic. What this means is that it will operate on many different networks, not exclusively Visa. So this can be seen as a way for Visa to further capture the economics in this high-growing segment, allowing Visa to monetize transactions that bypass the traditional Visa's payment network. And what we discussed earlier is that your credit cards, they offer rewards to the consumers. So for high-ticket items, it is almost impossible for your consumers to switch over. There's no incentive for them to do so. And also, another thing to note is that for your credit cards, your consumers can ask for a refund. But on this A2A transaction, they can't do so because your money is transferred over in seconds. So while one can argue that Visa's A2A offering is cannibalizing their existing business, one should also consider consumer behaviors. So as we discussed earlier, credit is still the preferred mode for high-ticket transactions. So if they lose the rebates and the rewards, they'll feel like it's a loss to them. And what we've seen in Australia is that your high-ticket items, they account for 40% of total card transaction value. This is the similar concept, and this is something called your K-shaped economy, where wealthy people, they don't suffer, they benefit in general, whereas the lower tier people, they typically suffer the most. So the true appeal of A2A lies in low ticket transfers due to higher speeds and convenience. And for high ticket items, it is largely unaffected because your consumers still need their rewards. Second alternative to Visa and MasterCard are your closed loop networks. So this includes American Express and your merchant-specific payment cards, like for example, your Starbucks card. There's a problem with this, which is that it increases friction. So your consumers, they don't want to have to hold 10 merchant cards. That is in response to your merchant cards. And for American Express, they target a different demographic of consumers. American Express is often associated with the highest income level, whereas Visa is trying to prioritize large-scale acceptance and transaction volumes across all income levels, and American Express only focuses on your high-income consumers. So there's very limited overlap. As for Discover as well as MasterCard, Discover is about 4% of market share in the US right now. But the problem with Discover is this: they were acquired by Capital One. So what happens is once you get acquired by a bank, the other banks, they won't issue the cards anymore because they can't control the data. In contrast, issuing Visa cards is more attractive due to Visa's broader acceptance, higher transaction volume, and stronger economic incentives. MasterCard is also another alternative to Visa. And I think for Visa and MasterCard, they can be seen as sort of like a tacit collusion. So it's a duopoly, it's a collusion between the two companies where they go for parallel pricing rather than the race to the bottom mentality. So for Visa and MasterCard, I typically see them as equals, although I think Visa is the more attractive one today, which I'll explain later on. So the other alternative is buy now, pay later. Buy now, pay later is very negligible. It's a very small segment of transaction volumes in the US, and they run on Visa cards also. Next one is stable coins. So the Genius Act actually institutionalized your stable coins, but the problem with stable coins lies in trust as well as friction, as usual. And what Visa is currently doing today is they're trying to increase the trust by also providing their own stablecoin networks. So it is a no-brainer for Visa and MasterCard's stable network to present itself as a strong and viable option for transactions as compared to your other different stablecoin networks. So the last one is agents. I think agents is something that is going to benefit this company because Visa will be able to monetize tokenization in something that other payment alternatives can't. And additionally, Visa is also expanding their offerings to merchants, and overall agents will likely be something that is positive for the company. Okay, so moving on to Visa's growth profile as well as how to think about the growth. Visa's future revenue drivers include volume growth, pricing growth, and unlocking of more revenue streams. I think volume-wise, it is made up of GDP growth, inflation, as well as maybe some increase in card adoption and population increases. So that's around 6% baseline. This is basically the floor if there's no recession, assuming that there's very minimal increase in its market share relative to cash, and if there's very little increase in card adoption, and the baseline is 6%, Visa generates around 49% from the US, and it's 54% debit and 46% credit. So debit has seen faster growth, although it is lower margin because of your interchange fee cap. Cards represent around 44% of global consumer transaction volume, indicating there is significant TAM, total addressable market, for future penetration. So payment alternatives like cash, legacy automated clearing houses, your ACH, run by the Fed, is currently very slow and it's not modernized. And cash is also another alternative that is defenseless, that Visa and MasterCard are actively taking away share from. So I'll move on to my theses for the company as a whole. So first of all is that Visa's increased focus on value-added services will be a significant growth driver that's underappreciated by the markets today. While value-added services currently makes up a smaller share of revenue compared to MasterCard, there's meaningful upside potential as value-added services scale. With management guidance on mid-teens earnings growth, this positions Visa for strong future profitability. assuming volume increases and value-added services adoption. So over here, my first thesis is this: Visa's value-added services will increase in terms of the proportion of revenue as compared to what it has been over the years, and this will sort of trigger a re-rating in the company closer towards MasterCard. So this is the first thesis. Second of all is that the current weak sentiment and regulatory headwinds around Visa serves as an opportunity to add into a company with a defensible business and a strong moat. So despite regulatory headwinds and constant chatter about interchange fees, Visa's existing business model has been strong over the years. So there's this thing that we covered earlier, which is revenue yield. Revenue yield is similar to take rate, and take rate has been increasing over the years. So I view the current regulatory headwind as noise rather than actual indication of worsened future economics, and Trump's comments are basically intangible. So I currently view this as an opportunity to add into Visa. And based on my valuation here, this is the base case scenario. I got a fair value of around $371 a share. This is assuming a beta of 1 times. Beta, it's a bit skewed. And at this price, the IRR is around 13%. And the bear case scenario, the fair value is around $317. This is an IRR of around 8%. So this is my thesis for Visa. Feel free to check it out. It's the newsletter in the description. I hope you guys have found this video useful, and I'll see you soon.